The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint with your weekly market deep dive for July 12th, 2021. Well, while it was a holiday shortened week last week, it was an eventful one, as is sometimes the case during these illiquid summer months. Starting with commodities in the US dollar, you can see the US dollar continues to struggle at resistance in this 93 area, while the euro continues to find support around 118. These areas are incredibly important because if the dollar gets back through it, you could clearly move back up to the top of the trading range, as you can see on the monthly chart to the left. Similarly, the euro could decline all the way down to the 108 area, which is a very large move in both those currencies. That being said, it was also an interesting week for crude oil. While we remain bullish on crude oil finally started to see a little chink in the armor last week. If you look at the top right chart, you can see for the first week in 4 or 5 that crude oil actually had a lower low than the week before. Again, we don't think this is fatal or the start of a new bear market, but if you might recall, there are some important areas of resistance up where we are now from those 2018 highs, and it's very natural for crude to see resistance in these areas and potentially run out of gas and take a bit of a breather. Looking at the rest of the commodities, the Bloomberg Commodity Index here in the middle remains in a healthy consolidation range. Copper has seen a pullback to its 20-week moving average. And even corn, while it's quite volatile, is really just going sideways and digesting the nice move it's seen over the last 6 months. The bottom line being, commodities continue to look like they're bending and not breaking, and the dollar is again right at an important area around 93. Taking a little deeper dive into the oil market, we have 2 charts on the left and 2 charts on the right. Starting with the left, you can see the one we normally show each week, which is the 1 month out and 12-month out Brent crude oil contracts in the top pane. Then the difference between those contracts is in the bottom of the left pane. When the indicator is in the green, it suggests a backward market or describes a backward market, which suggests a healthy environment for the oil market. When it's in red, it's in contango. And again, that's a less healthy situation for the oil market. You can also see those 2018 highs I mentioned on the previous pane. And in Brent, it's right around the 80 to 84 area, depending on which contract you're looking at. So as we approach these areas, we should find them to be areas of resistance on the chart. Again, very similar to earlier in this year when we got through the downtrend and ran into a little resistance in the high 60 area. Looking at the right, you can see a much longer term view of the markets back about 15 years. And the points here that are important is you can see, again, that area of resistance as measured by the blue line, which is crude oil, the first 1 month out contract. And then the white line is the rig count, meaning the number of rigs in the field pulling oil out of the ground. So the way we use this indicator is as a confirming indicator. And you can see that when the price of crude oil is rising, very often rig count rises to match it, as it did here in the 2009, 10, and 11 timeframe, also in the mid-teens. And when crude is declining, companies typically pull rigs out of the field due to those declining prices. And you can see, again, another lagging but confirming indicator. Their point being here, given that rig count is expanding and is up to 479 rigs in the field, you can argue that the oil market, again, is in a long-term or in a cyclical healthy configuration. Looking even longer term, however, at the secular picture, the green line shows the number of futures contracts forward sold, or the net position, by the producers of oil or people who pull oil out of the ground. They're known as commercials or hedgers. What's interesting about this is you can see it has been in a downtrending channel for, again, roughly 15 years. The point being, this is the people who use oil and sell it as part of their business. expressing a increasingly bearish opinion about the price of oil. Otherwise, they wouldn't be selling it forward at a higher and higher rate. They're currently short roughly 550,000 contracts, which again is one of the larger numbers on record. We believe this means that the secular picture for fossil fuels is less robust. And if you just look when you drive into work, you'll see a ton of Teslas out there and other hybrid vehicles. And we think this chart indicates that that really is a durable trend and the trend of the future. Looking at global yields, I have two charts this week. The first one on the bottom left is the current yield curve in the United States as measured by the solid green line. And then the yield curve a month ago in the olive dotted line, 6 months ago in the dashed green line, and 12 months ago in the dashed gray line. The point being, you can see that over the last 6 and 12 months, the yield curve has steepened pretty dramatically, which is good news and a sign of solid economic growth. Over the 1 month period, however, you can see a flattening in the yield, meaning the front end of the curve is up over 1 month, the longer end of the curve is down over the 1 month look back. And that is a flattening of the yield curve, which isn't that exciting or less bullish, we should say, going forward. It's just a 1 month look, and we believe it's a function of the consolidation we've been seeing in the market, which again, you can see in the right-hand pane. This is a 5-year look back of several key interest rates on the 10-year basis going forward around the world. And you can see, again, the strength in the US 10-year Treasury yield, which has seen consolidation over recent and a significant pullback. The British 10-year has also been strong, but has pulled back to digest its gains, as has the German 10-year and the Japanese 10-year to a certain degree. Looking a little deeper at the US market, this is really where some of the fireworks were last week. We've been talking about the declining trend channel on the daily chart, as you can see in the top left of the 10-year US Treasury. And the 10-year US Treasury fell dramatically out of that channel last week and actually down below its 200-day moving average for 2 days. That being said, it has held. It bounced sharply off that 130 area. And it looks to us like this could be a bear trap in interest rate yields, meaning a false breakdown and one that is quickly reversed. While it will take a week or two to say that for sure, we will only know in hindsight. Interest rates are typically a very choppy instrument, as you can see in this trend channel. And we are also seeing indications that substantiate a bear trap. Think back to that commodity page. You've seen strong commodities. The longer term interest rates are usually a reflection of inflationary pressures. And as you'll see here on the next slide, credit spreads remain benign. So again, it doesn't look like there are any real economic troubles ahead for us, which means the chances are at least reasonable that this is a bear trap in interest rates. If you look at the weekly chart, you can see another reason over to the right why we think this may be a fake out instead of a start of a new trend. And that is due to the 5-year Treasury note, which is the olive line or the olive set of bars just below the 10-year in black. While there's a lot on this chart and it's getting pretty busy, one of the important lines is this 70 basis point area of support on the 5-year. You can see the 5-year has been holding that like a champ since late last year. So again, as long as the 5-year is holding and the 10-year is bouncing, we're going to give interest rates or higher interest rates benefit of the doubt. Looking at credit spreads, you can see exactly what I meant with a lack of a warning shot from credit spreads. The purple, brown, and bluish lines are the difference in corporate bonds compared to US Treasuries as measured by the interest rate spread. If you're buying an investment grade corporate bond, you might only get 1% ahead of Treasuries or over Treasuries. If you're buying a high yield bond, you might only get 3% above Treasuries. And if you're buying a triple C rated bond, only 4.5% over the 10-year US Treasury. The point being, these relative spreads can tell you whether the economy and the financial markets are in a healthy configuration or less so. typically they widen out before there are problems in the stock market. And you can see right now, there's no evidence of widening out whatsoever. Moving on to stocks, if you look at our value line chart, we're only looking back 10 years again, as we did last week in the value line, because I wanted to look at some of the more recent market action a little more clearly. The indicator below the value line is the RSI, and the indicator below that is the percentage of stocks above their 200-day average in the value line index. The point being, these indicators usually diverge pretty widely and broadly ahead of major market tops. Again, if you look back in 13 and 14, you can see the value line index advancing, the RSI staying overbought for more than a year, the number of stocks above their 200-day moving average diverging slightly, but really getting into a significant divergence by the time the peak in the summer of 2015 hit. This peak in the number of stocks above their 200-day didn't even hit the 60 level, and the RSI could not get back above 70. A similar phenomenon happened at the top in 2018, a major divergence in the RSI, as well as in the indicator on the bottom. But yet, so far during the rally in 2021, no time to make a major divergence, and certainly no divergence evident. That being said, while the trend in the value line has been rock solid and quite strong, you're starting to see these indicators, I won't say buckle, but get a little bit shaggy. The RSI is trading almost down to 60, or got almost down to 60 a few weeks ago. And you can see the percentage of stocks above their 200-day now below 80% again. So while these indicators are not forming major cyclical top type divergences, the indicators typically weaken before the index. So this is another reason we think there is potential for a consolidation or correction or further rotation on the horizon. Looking a little closer at our stocks, you can see daily charts of the S&P 500 and NASDAQ on the left-hand pane, along with market internals, such as the advanced decline lines and the number of stocks making a new 52-week high. These are important indicators and are truly the pulse and blood pressure of the markets. What's interesting is if you look at the S&P 500, you might recall several weeks ago, we had a blue box right in this area, because as the S&P 500 went sideways, the number of stocks which were advancing broke out to the upside and suggested the S&P was going to break out as well, and it certainly has. What has changed over the last couple of weeks is now it's the reverse. As the S&P has continued higher, you're not seeing the number of stocks continue higher. And we think this is evidence of a large cap FANG rally, which we'll talk about here in several slides. That FANG rally has been responsible for the NASDAQ moving out of this triangle pattern to the upside and seeing the strength it has seen. Pardon me. If you look at breadth and leadership on the NASDAQ as well, however, you are starting to see some divergences. The advanced decline line has not made a higher high compared to where it was in February or March, even though the NASDAQ composite has. And you're certainly not seeing the number of new 52-week highs as you did back in February and March. They're currently peaking out around 200, whereas in February and March, they were up around 700. You can also see these divergences on the weekly charts, meaning the NASDAQ moving higher and fewer new 52-week highs, and the percentage of stocks above their 50-day actually diverging pretty dramatically versus the S&P 500. So again, while the percentage of stocks above their 200-day, which we looked at the previous slide, is again rock solid, the percentage of stocks over the 50-day, or a shorter term indicator of momentum, is starting to wane. So that being said, looking at the indices to the right, you can see none of them are forming major top patterns. None of them have broken their 200-day average or their 40-week average. And some of them are pulling back while others remain strong. So that's that rotation and split tape that we're starting to talk about. Specifically, the Dow Jones Industrial, which is mainly a large cap index, is nearly at a new all-time high, whereas the Dow Transports and the S&P 400 mid caps are not at new 52-week highs, but look more like a consolidation or congestion pattern. Looking a little deeper at the sectors, you can see exactly what I mean by being a FANG rally, in that the NASDAQ Composite and the S&P 500 were actually up last week, whereas the mid caps and small caps were down. And the Russell 2000 was actually down a full percent. If you look at the style boxes, the IWF, which represents the Russell 1000 growth or the large cap growth stocks, it was up. And the other three style boxes were actually down. We noted last week that even though interest rates were lower, you did not see a bounce in the real estate, in the REITs or the utilities sectors, which was uncommon. Typically, when rates are up, you see the financial stocks bounce, but when rates are down, you see strength in utilities and REITs. Well, rates were down again last week, and we finally saw some strength in the REITs and utilities as they're up here at the top of the chart, with the REITs up 2.6% last week. Finally, while they were strong last week, those defensive sectors, they have been weak longer term. And I know that sounds confusing, but if you look at the bottom left chart where my pointer is, and just to the right of it, which is the consumer staples sector, even though they have been trending higher for a year, you can see based on the green line that they're not going higher as quickly as the S&P 500. The green line in all of these charts is a line of relative strength, meaning how is this sector performing compared to the S&P 500? And you can see those defensive sectors such as staples and utilities made lower lows over the last several weeks. So again, where things like the communication sector and the technology sector were leading the rally the last several weeks, it's good news longer term that the strength in the market is not in these sectors that are typically strong toward the end of a market cycle. Finally, taking one last look at that rotation, I wanted to circle back on a couple of the sectors we've been discussing over the past couple of weeks. On the top left, you can see the bank stock index, and just below it, the insurance group. And while those groups have been quite strong and recently broke to new all-time highs, they have been consolidating those gains in a really orderly fashion over the last 3 or 4 or 5 weeks. That being said, the internet stocks and the ARK Innovation ETF and even the semiconductors have moved out to the upside, just as you've seen in the NASDAQ. So again, groups that consolidated during the first quarter or so of the year are now moving higher, whereas those that were higher and stronger during the first quarter of the year are now consolidating. You can even see it in the FANGs themselves. I've shown Apple and Amazon at the bottom of the pane. You can see Apple has been strong the last 2 weeks and is now at an all-time high. Amazon also broke strongly to an all-time high last week. Now, again, while these stocks look overbought over the short term, I would suggest that given they've been in a trading range for roughly a year, that this breakout is probably going to lead to an extended move higher, both in Apple and Amazon. So we could see this phenomenon continue where the FANGs are pushing those market averages higher, while things like banks and insurance companies continue to correct and consolidate. Not broken charts by any means, but again, it would be very normal to see these breakouts tested and these prices fall down to these blue dashed lines. Looking at the volatility surfaces within the market, it was another pretty interesting week. If you look at the difference between the volatility surface on the SPY from 7.2 to 7.9, you can see the entire curve is lower, which is, again, people selling volatility because they're fairly complacent. Also, if you look at the SPY and the volatility index, or the VIX, you can see the VIX at some very low levels down here between 15 and 20. That, again, is the lowest it's been since the COVID collapse, and also suggests complacency with options participants. Looking a little bit more at the sectors, you see some interesting things. Number one, you can see the strength in the NASDAQ compared to the S&P. Again, the green line is the up vol skew, with the red line being put vol skew, and the skew for calls is stronger than the skew for puts. So the NASDAQ is in a more bullish configuration than the S&P, where the put skew is leading or higher than the call skew. So that's a bit of a negative configuration. Not hugely bearish, but again, you can see the creeping up over the past several months of put skew in the S&P has been stronger than the put skew creep in the NASDAQ. One of the reasons has been those semiconductor stocks that continue to be rock solid and benefit from some supply shortages. So you can see option participants are still very bullish on the semiconductors, although potentially less so than over the last month, with call skew still rock solid above 90%. However, put skew now perking its head above 20%. So yes, down week over week, but this slow creep of put skew suggests the semis are, the momentum of the rally in semis may be weakening. One area that we think is particularly interesting is the dollar. We mentioned several slides ago that the dollar is finding resistance in the 93 area, which is an important area on the chart. And you can also see the options participants showing a very volatile market with both put skew and call skew above 80%. That suggests people are placing bets both ways, and this market could see a dramatic and violent break once it goes one way or the other. Finally, regarding the overseas markets, a similar picture that we've seen the last couple of weeks in that they are in uptrends, and like the US market sectors, different stages of those uptrends. If you look down the center pane, which are the developed markets, you can see the DAX, the ETF that represents France, the ETF which represents Britain, all a little bit extended and maybe starting some pullbacks. The two below, however, which represent Japan and South Korea, they led the rally off the lows last year and have been consolidating for, again, almost 6 months in both their cases. So extended consolidations have been developing in the bottom two after being early leaders. Now the followers are starting to consolidate, and only time will tell how extensive of a consolidation that becomes. One other point we wanted to mention is the Chinese markets. We've been watching the top two charts for windows into the health of equity markets globally. The Chinese markets strongly off the COVID lows last March. They led the way higher with some very, very positive action. And they were also among the first to correct starting this year. While some of the charts in the Chinese markets are really looking to be in rough shape and seeing some bad breakdowns, such as Alibaba, the group overall, you can say, is still holding support as defined by both the MCHI ETF and the A-shares ETF, which is ASHR, or at least so far. Finally, we normally have a COVID slide this time of the brief, but First Trust has discontinued their COVID tracker on its 1-year anniversary. For those of you that didn't see it, they did a wonderful job of monitoring COVID in a very factual and data-oriented manner, and that's something we will definitely miss. We will also miss how dispassionate they were about the data and the fact that they stuck their neck out and providing their view on what was going on. And I thought it was pretty interesting, and I highlighted it here in green, that they believe, as history looks back, they believe locking down the economy will be viewed as one of the most damaging public policy mistakes in all of world history. They can substantiate this with this verbiage above on the slide, and of course below. I'll let you read that for yourself, but again, that's a slide we're definitely going to miss. So finally, in summary, commodities continue to bend but not break, as does the US dollar. This 93 area is very important because clearly if it fails and 90 breaks, you could see continued devaluation in the dollar and continued strength in commodities, which could lead to some literally runaway inflation. That hasn't happened yet, but it just leads you to believe that these are very important areas and a potential first domino that would kick off other trends with the dollar. As for interest rates and the credit markets, you have seen some very strong action in the interest rates as well. That is being called into question with last week's break of 140 in the 10-year US Treasury. But again, we're going to give that break a little bit of the benefit of the doubt because things like the LQD, which is below it, remain quite strong, and that represents the credit markets and the friendly tone of the credit markets. As for stocks, it continues to look like we're in a cyclical bull market. We have seen several divergences form over the near term, however. We've seen the FANG strong at the expense of things like banks and energy companies. So again, we think the market is seeing the best chance for a consolidation now than it has since the lows last year. That being said, the NASDAQ just moved out of consolidation. And so anything that happens to the S&P would likely look like this benign trading range you saw in the NASDAQ over the last 4 or 5 months. If you look to the right, the risk measures remain solid or in uptrends, with the ratio of consumer discretionary stocks to consumer staple stocks just breaking out recently. Obviously, this is very heavily weighted in Amazon, but again, you can see the Amazon factor in this index, in this indicator here. Finally, the overseas markets remain in solid uptrends as well. Many of them are seeing consolidations as well. So again, a bit of a mixed tape overseas, but a very positive picture overall. I've been Mike Hurley, Chief Market Strategist for NexPoint, with your market deep dive for July 12th, 2021. I hope we get to see you again next week.